So, you hear this all the time, right? Goldman Sachs says Nvidia and Apple are cheap. You see it all over the news. But then you glance at a stock chart and they're sitting near all-time highs. So what gives? Are we looking at a massive opportunity, or is this just a really well-disguised trap? Okay, let's dive in and solve this valuation paradox that's at the very heart of the market today.
This is the big question, isn't it? It feels like it just doesn't make sense. How can a stock be at its most expensive price ever and, at the same time, have Wall Street calling it cheap? Well, that confusion is exactly the trap we're going to dismantle today. We're going to look at the tools the pros are using and, maybe more importantly, the ones they might be forgetting about in a world that could be facing an energy crunch come 2026.
In this right here, this is where things get tricky for a lot of investors. You've got these institutional experts with their super complex models on one side telling you it's a bargain, and on the other, you've got the simple, cold, hard reality of a stock chart that just keeps climbing. That disconnect is where people can get into real trouble. Our job today is to bridge that gap.
All right, so our investigation starts with the usual suspect, the one clue that pretty much everyone grabs first, the price-to-earnings ratio, the PE. And look, it's popular for a reason, it's simple. But here's the brutal truth. For about 90% of investors, the analysis stops right here. And as we're about to see, that makes it a really, really misleading first clue.
It's a pretty elegant idea, really. If a stock has a PE of, say, 20, it just means you're paying $20 for every $1 of that company's annual profit. Simple. So a lower PE is generally seen as cheaper and a higher PE is seen as more expensive. It's the first place almost everybody looks. But this is where our mystery really kicks into gear.
Okay, so take a look at this. This is where the trap is really set. The hard data tells a story that looks almost too easy. When we put a tech giant like Apple up against a classic value company like Toyota, the case seems open and shut. On pretty much every traditional metric, PE, price to sales, price to book, Apple is trading near its most expensive level in the last decade. Toyota? It's chilling down near its 10-year low. Based on this clue alone, Apple looks wildly overpriced.
And that's the trap. See, if you stopped your investigation right here, you'd sell all your tech and pile into industrial stocks. Case closed. But the thing is, the folks at Goldman aren't stopping here. They see something else. And that tells us that the PE ratio, our first clue, is not the whole story. It's a classic red herring. It's telling us about the price, but it's completely missing the most important piece of the puzzle.
So what is that missing piece? Well, it's one word: growth. A company's value isn't just about what it's earning right now. It's about what Wall Street thinks it's going to earn tomorrow, and next year, and 5 years from now. This is the entire game when it comes to growth investing, and it is the absolute key to cracking this Magnificent Seven paradox.
Let's make this crystal clear. Picture two companies, Company A and Company B. Both of them are trading at a PE ratio of 30. So based on our first clue, they look equally expensive. But now, look at that second line. Company A is growing its earnings at a pretty decent 15% a year. Company B, though, is growing at a blistering 40%. Their price tags today look the same, but their futures? They're on completely different planets.
So I'll ask you straight up, which one would you rather own? It's kind of a no-brainer, right? You want the one that's growing like a weed, because that kind of explosive growth can make today's expensive PE ratio look dirt cheap a few years down the road. This is exactly why the PE ratio by itself is so dangerous. It shows you the price tag on the car, but it tells you nothing about the engine under the hood. We need a tool that can measure both.
And luckily for us, that tool actually exists. It's called the PEG ratio, and this is how we're going to crack the code. This is the metric that connects all the dots, the price, the current earnings, and that all-important future growth rate, all in one beautiful little number.
And there it is, the price/earnings to growth ratio, PEG. This is the one the pros are looking at. It's so simple, you just take the PE ratio and divide it by the company's annual earnings growth rate. That single calculation gives us a much, much smarter way to look at value, and it helps us answer the big question: am I paying a fair price for this company's future?
So let's run the numbers for our two companies. For Company A, you take its PE of 30, divide it by its 15% growth rate, and you get a PEG ratio of 2.0. Now let's look at Company B. You take that same PE of 30, but this time you divide it by that huge 40% growth rate. The result? A PEG ratio of just 0.75. All of a sudden, the picture is completely flipped. The company that looked just as expensive is now looking like a potential steal.
So here's the key, the simple rule of thumb you need to remember.
A PEG ratio under 1.0 is a sign that a company might be undervalued. And this is the logic behind all those headlines. When an analyst says NVIDIA is cheap even with a high PE, what they're really saying is its PEG ratio is probably under 1. But, and this is a huge but, the G in PEG is just an estimate. It's a forecast. And those forecasts are often based on a perfect world, not one that might be staring down supply chain issues or energy problems.
But hold on, we're not done yet. Any good detective always runs one last test. Even if a stock looks cheap based on these super optimistic growth forecasts, we have to compare it to our other options. And there is one competitor that every single investment in the world has to beat: the risk-free rate of return.
Think of it this way. This is the interest rate you get for loaning your money to the US government for 10 years. It's basically the safest investment on planet Earth. Any dollar you decide to put in the stock market is a dollar you could have put here with practically zero risk. So any stock you buy has to offer a potential return that's good enough to make up for all that extra risk you're taking on. It's the ultimate reality check.
So how do we put these two head-to-head? We use something called the earnings yield. It's super simple. You just flip the PE ratio on its head. It's the E for earnings divided by the P for price. A stock with a PE of 30 has an earnings yield of about 3.3%. So you put this potential risky reward from the stock right next to the guaranteed reward you get from the treasury.
And this, well, this is where the argument against some of these giants gets really, really strong. Right now, Apple's earnings yield is sitting around 3%, but the 10-year treasury yield is up around 4.5%. That means the extra bit of return you get for taking on all the risk of owning Apple stock, what's called the equity risk premium, is negative 1.5%. I mean, let that sink in. To justify buying that stock today, you're not just betting its growth will be good. You're betting it'll be so incredible that it overcomes this deficit and beats the safest investment in the world. That's a huge bet.
So, after going through all the clues, what's our final verdict? Well, the answer isn't a simple buy or sell. The real answer is that you are now armed with a much smarter toolkit to cut through all the noise from Wall Street and make that call for yourself. You now know that the PE ratio is just a starting point. You know to use the PEG ratio to figure out if you're paying a fair price for growth, but also to be skeptical and ask if that G for growth is even realistic. And maybe most importantly, you now know how to use the 10-year treasury as that final critical reality check to see if the reward is actually worth the risk.
And this quote right here, it really just drives home the tension in the market. You have these handful of stocks that make up this huge chunk of the index based on their price, a weight, that is way, way bigger than their actual contribution to the total profits of all 500 companies. That gap is a bet. It's a massive, market-wide bet that future growth is going to be absolutely spectacular.
What this means is that those growth expectations have to be crushed quarter after quarter, year after year, with no mistakes. If that growth starts to slow down, if that E in the PE ratio has to be revised downward because of real-world pressures, the whole valuation argument starts to crumble. So the final question you have to ask yourself is this: given the stakes, is the reward worth the risk? Or is the Magnificent Seven trap about to spring? Thanks for joining the investigation.